Market Overtime. I'm Oliver Renick. Today we're assessing the impact of a 50 basis point cut from the Fed and a new regime, perhaps a new cycle, arguably, as the Fed looks to reverse policy and a victory, arguably, over inflation. There's a lot here still hanging in the balance. Joining us to talk about the economy, trading, and more, Luke Gromen is the founder of FFT, Forest for the Trees. Luke, thanks for being here on Market Overtime and sitting down with us for an extensive chat.
Thanks for having me on, Oliver. It's great to be here.
So this has happened after a pretty seminal event. We got finally this reversal in policy. As we are recording right now, stocks trying to break out, markets trying to go a little bit frothy. Start me off generally with how big of a shift you think that is that we did begin a cut cycle.
I think it's a very important shift. And I think the reason for the shift is the most important of all, and that is that the U.S. fiscal situation requires Powell to cut, full stop. Okay. Because what we've defined as U.S. true interest expense, which is their interest expense plus the current portion of entitlement expense, is nearing 100% of tax receipts. And so they need higher stocks, they need higher growth to float their interest, their true interest expense, and so here we are.
Anybody who is like not super glued into the macro type of like view that you're in, Luke, is going to hear what you just said and they're going to go, wait, the Fed didn't say any of that stuff ever. They've told us they're cutting because inflation was at 10%. Now it's getting closer to 2%. Economy just got revised to 3% expected GDP and the stock market's at all-time highs. They're going to hear that and they're going to say, it seems like things are pretty much fine. Where is the evidence that you see that something's broken here?
It's in the fiscal side. Everything absolutely is fine in nominal terms, right? You can look at it and see in the fiscal position. In 2016, we highlighted that what we called the big three expenditures of the United States: entitlements, defense, interest. They were about 67% of tax receipts. By 2018, after the Fed hikes, they were up to nearly 85%. At the peak of COVID in 2020, they were at about 105, 110% of receipts. And what happened? The Fed had to do QE to basically print the money to finance the deficit. The Fed rate hikes, or the ensuing inflation of asset prices and strong nominal GDP growth driven by inflation in 2020, 2021, and into 2022 took the U.S.'s big three expenditures as a percent of receipts back down below 100% of receipts. Mm-hmm. That's a very polite way of saying the only thing keeping the U.S. government solvent on a nominal basis was the very inflation the Fed started to fight. And so as they hiked rates on 125% debt to GDP, they sent interest expense from, call it, $400 or $500 billion a year to running at about $1.2 trillion per year. So they added $600-800 billion, so 3 to 4% of the deficit all by itself. Inflation or entitlement spending rose as well, and so you can see very clearly as this last year has progressed, U.S. true interest expense, the entitlements plus the interest, has been moving towards 100%.
There's all these things that are happening on balance sheets and paper, but again, the experience is that still post-COVID, real wages have stayed elevated. They've cooled off. They've come down from the obvious stimulus highs, but still on a very good trajectory post-COVID. I mean, do you think stocks are in like a massive bubble? Because if the stuff that you're talking about is like going to be the beginning of the like end of the U.S. empire, then like how come equities are making highs? How come our GDP is continuing to get revised? And how come the dollar is actually holding in fine? I mean, I know you're a dollar bear, generally, correct me if I'm wrong, but like we're hanging out fine and the dollar price is, you know, unless you compare it to gold or a Bitcoin or a stock or something like that.
Well, and that's exactly it, is that the bubble is in Treasury bond. I think stocks are actually, I'm very bullish on stocks. I'm very bullish on gold. I'm very bullish on Bitcoin. And in particular, I'm very bullish on industrial stocks and have been for most of the past 2 years. And the reason for that is very simple, which is the United States needs negative real interest rates In other words, interest rates below the rate of inflation, and in particular below the rate of nominal GDP growth, just to avoid a very bad outcome. And we've seen glimpses of what a very bad outcome looks like. We saw it last year in the third quarter of 23, when we had the dollar up and stocks down, bonds down, everything down except gold and the dollar. We saw it for a moment earlier this year. For a very brief moment, we saw it in the third quarter of 2022. But the point is that
well, Luke, that's a really important point, though. I want to come back to real quick because again, like if there's going to be real ramifications here, it feels like the measurement, the things that we have to measure, basically health of the economy, even by transition, arguably like the society, one of them is the profit, the earning, and the potential of the U.S. equity market. So while these things have happened, stocks have done fine. So when you say like the problem is that bonds are in a bubble, I mean, bonds sold off like crazy for 2 years straight. Stocks made it through. GDP made it through. Unemployment, we're still in a low 4 handle. I mean, like, so if bonds
exactly
selling off hard, was that not a bubble pop and we're okay? Did bonds not pop a little bit?
That was a nominal. No, bonds sold off nominally for a cup of coffee. However,
what do you mean?
What you're seeing,
ultimately, the 10-year going from like 1.5 to 5. Like, I mean, that's a massive sell-off we had in bonds, and it seems like we made it through okay.
Oh, we absolutely did. Ultimately, because more liquidity was injected to keep it from going to 7, for example, or to 8. The U.S. government's debt load cannot afford 5%. And as a result, every time we have had bonds sell-offs driving volatility, too much volatility in the Treasury market, the Fed has tamped down, either the Fed or Treasury or both working together have tamped down on bond market volatility, Treasury market volatility, by injecting more dollar liquidity into the Treasury market to keep the Treasury market functioning. And when they do that, that's very good for stocks. And you can see this if you call up a chart of S&P over TLT, the long bond. It's up and to the right. It's doing a hockey stick. You can call up a chart of gold over TLT. It's up and to the right. It's a hockey stick. Bitcoin over TLT. Ultimately, what's happening here is that the U.S. fiscal situation requires negative real rates. The bond market is $130 trillion. The Treasury market alone, we've got $35 trillion in debt. The market's probably a $25 trillion market. There is no balance sheet in the private sector out there big enough to absorb negative real losses on a $35 trillion in U.S. debt. And so what is happening is the $130 trillion bond market realizes that the United States is going to have to sustainably inflate its debt away, and it's beginning to shift out of the $130 trillion bond market into the $65 trillion equity market, into the $14 trillion gold market, and into the $1.3 trillion Bitcoin market. And so what you're going to see, what you have seen in response to these dynamics on the fiscal side I'm laying out, is precisely what you would expect to see, which is S&P up against the long bond, gold up against the long bond. That's something, if everything was awesome, gold would not be rising when real rates are rising.
The connection, though, too, which I'm still want to try and drive at, because the bond and the connection to the flows that you're talking about, it seems like you're arguing the flows are going to come out of Treasury because people lose faith in the U.S. bond market, the U.S. sovereignty situation. They put their money into these other assets. But it looks to me like still some of these correlations don't add up because, yes, we had some volatility and bonds were selling off, stocks were down, but we've recovered. And then you've got bonds rallying big here again, and the stock market has continued to recover. It's just this correlation seems like it hasn't come to the point that you're describing yet that would be this massive disruptive force. So like, what do you look for to know when this type of exodus is happening? Because there's still plenty of people showing up at our bond auctions. Like, we had a couple scares when we had real high inflation, but the auctions continue to find demand here and abroad. I hear the point that the central banks are buying gold, but I mean, it's not like they're tanking our bonds either. People are showing up big the last 2 months.
Well, any given month, number one, but number two, what we've been saying all along is when the dollar gets too strong, they won't show up. And when the dollar gets weak enough, they will show up. And so the dollar has fallen from Since May, 105, 106 to about 100, and the auctions have gotten better. And if the dollar keeps falling in an orderly manner, the auctions will continue to be good, and long-term rates will continue to be relatively low. The sort of proof in the pudding is very, very clear, and it's 10 years old. You can go back. I have a chart on my X feed. You can look at U.S. federal debt, and it's a hockey stick, of course, and you can look at global foreign official central bank buying holdings of U.S. Treasury bonds. And global central banks stopped growing holdings of U.S. Treasury bonds in 2014. They're down versus 2014. And so the foreign private sector has bought a little when the dollar is weak enough, when the math makes sense. But with that happening, it's been a very predictable set of dynamics that it actually ultimately repeatedly forces dollar liquidity to be injected and drives, you can see in the chart, if you call up a chart of the S&P 500 over the long bond, massive outperformance. Okay, well, maybe that should happen because stocks ultimately have an equity premium, blah, 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 blah. Okay, gold should not massively outperform the long bond. They are directly competing assets, directly. There's no competitor to the long bond of the United States other than gold. And gold is crushing the long bond over the last 5, 8, 10, 11 years, number one. Number two, more importantly, even arguably in terms of an acceleration metric of this, gold, over my entire career, I've been doing this 30 years, gold always traded with inverted U.S. real rates.
Sure,
if you look
yeah,
at
that's broken.
10-year, and
that's
it's
a
completely
very
broken.
important chart. Yeah, that's a very important chart.
That is something that Western investors, American investors in particular, look at it and go, oh, that's curious. And every emerging market investor I talk to, they know what that's saying. They're like, we've seen this before. This is the easiest message to understand in the world. What gold going up on real rates means is your country is in the early stages of a fiscal problem, of a fiscal crisis. It means that your country cannot afford positive real rates and will eventually come back and start cutting rates by 50 basis points with nominal GDP growing 5-6%.
How do you know the gold flows are a reflection, gold, a global asset known to man since the beginning of time, basically? How do you know that the reasoning for folks buying that is specific to a U.S. fiscal situation and not a global one in someone's home country or whatever it may be? Because again, as long as there is some, equity market, some capitalistic system, right, one of these countries is going to be the best house on the block. And that's where it seems the U.S. has routinely found itself time and time again. How do you know that some of these worries on the fiscal side that are causing gold flows are not coming from other places? Like, how do you know it's a reflection of U.S. specific risk? Gold's a global asset.
Well, in part because the Treasury bond has been the world's primary reserve asset for 40, 50 years, and still is, and arguably in terms of scale, but global central banks stopped reserving it 10 years ago, number one. Number two, the U.S. runs the biggest deficits. So when you look around and you say, okay, well, if it's other fiscal problems, China's running a surplus. China's lending $1 trillion a year to the world. Is it China's fiscal problem? China's got problems, don't get me wrong. It's not China's fiscal problem, okay? Is it Russia's?
But if I'm in China, I might want to own gold if I'm in China. I mean, there's some pretty good reasons to own gold. I've got a government that's been messing with my private sector nonstop for decades, a stock market that's been sluggish. Like, there are other reasons that come in here besides. My point is, like, when you say gold and bonds are interchangeable, like, that's taking the 60-40 portfolio and throwing it out the window, basically saying that, like, nobody thinks about it like that. I mean, still a lot of people still put them as very different things. So, like, there's a reason why a Chinese population could be coming for gold.
Oh, the Chinese population has reasons to buy gold. The Russians, I mean, the world.
Yeah, that are not U.S. fiscal problems.
Oh, no, it's not just fiscal problems. But in the end, the United States is the world's reserve currency issuer. The world's reserve currency issuer doesn't get to have fiscal problems. And if they have fiscal problems, it's going to show up everywhere. And to your point, where else do you go if the world's reserve currency has fiscal problems? If the cleanest dirty shirt is now dirty, you go to gold. That's the only other shirt to go to. And that's the message of gold crushing the U.S. long bond over the last 5 to 8 years. That's the message of gold rising sharply despite a sharp rise in U.S. real rates. That's telling you that not only is the world saying the U.S. Treasury bond is not safe on a real basis, it's absolutely AAA rated on a nominal basis. You're going to get every dollar you're promised. Yeah. But what gold crushing the long bond of the United States over the last 5 to 8 years, and in particular, the gold rising against rising real rates in the U.S. is telling you is that the world is voting with their wallets. Markets, the global market, global capital is screaming as loudly as it can that the United States government cannot maintain the real value of its treasury market due to its fiscal situation, and therefore I am going to buy marginal amounts of gold.
Okay, well, I still contest that the gold and bonds is a very fair comparison. I hear the argument, but you've got also a U.S. stock market that's roaring, which is beating gold. So if you go by price performance, I mean, stock market's beating gold over the last 10 years. Obviously, Bitcoin's going crazy.
Last 3 years, it hasn't.
That's fine, sure, totally. But if you're kind of talking about this whole kind of run up in debt, it feels fair to stretch it back to post-GFC as kind of your starting point, which is kind of what I'm doing there. But here's the other thing, too, again, is that, Luke, if all of this comes true about the sovereign risk, why would I want to park so much money in U.S. domiciled companies that, I mean, if their home state is on the verge of collapse, why are U.S. equities constantly also catching that, if you will, arguably safety bid, even if you do want to call it that?
Well, that's a very American viewpoint, as it's American companies are short dollars. They're a way to short the dollar. Ultimately, think about this. American companies record their profits in dollars. Their debt is in fixed rate dollars. So if inflation picks up, the real value of corporate debt's going to fall, the real value of equities is going to rise, just from a balance sheet perspective. Their revenues are going to surge with the growth. If nominal growth in the United States is going to rise because inflation rises, their nominal revenues are going to rise, the real value of their debt's going to fall, the equity becomes more valuable. That's just formulaic accounting 101 double entry bookkeeping.
Well, but it's not just nominal, though, because we've got real growth, too.
If we take a step back,
right? We've got real growth.
If we take a step back, then we can also say, well, if a stock market being at all-time highs is a great arbiter of real growth, you have to explain Argentina. The best performing stock market over the last 10 years in percentage local currency terms is the Argentine stock market.
Sure, I know, but that's my point, Luke, is that's why you can't justify gold just alone by its price performance. You're saying gold is reflecting all of these fundamental things by virtue of its price performance. So you're leading exactly to where I want you to, which is that price performance does not dictate necessarily some fundamental truth, right? We've got to have something underneath it. I'm saying that if
you just said that the price performance of the stock market dictated the fundamental truth.
No, I'm asking if you believe it does. I'm asking if you believe it does, because if your view about the Treasury situation is going to blow up the sovereignty of the U.S., I wouldn't think I would want to be.
Hold on. I didn't say that.
Is that not what's happening? Okay, so what's the end game then?
That. I didn't say that. Don't put words in my mouth.
Okay, because it seems like you're saying we're beginning the trajectory. I believe you said earlier the beginning of major fiscal problems, right? So, like, yes, what's the end game of that if not threat to the sovereignty?
That's true. There's no threat to the sovereignty.
Well, doesn't that happen if our entire funding mechanism blows up like you're projecting? I think that it would, right? Isn't that kind of the point?
What does blow up mean?
Well, that's your case, because it seems like you're bearish bonds. The bond market's in a bubble.
You're putting words.
Right, you told me the bond market's in a bubble. So I'm asking then, what are the ramifications? What are the ramifications then, if not something in the equity world or anywhere else?
Okay, I am going to say this again slowly. The ramifications of a bond market bubble at the sovereign debt level. The United States can't go bankrupt. Why? Because it can print the currency that it owes its debt in. Mm-hmm. If they're going to do that, if they have begun doing that, that is going to drive the stock market to all-time highs, like we are seeing. It is going to drive gold to all-time highs, like we are seeing. We are going to see the stock market in all-time highs in dollars, but not in gold, which is precisely what we're seeing. It's the same dynamic that we're seeing in Argentina, which is that the stock market in Argentina is at all-time highs in pesos, but not in dollars and not in gold. That's
the stock
what we're
market
seeing.
is at all-time highs in gold, Lou.
But it's not.
Okay, well, the trajectory, when you're saying, if you're applying causality to the growth of the debt issue, which has been growing since the GFC, stock market's beat gold since then.
Of course it has. Now do the Fed's balance sheet.
Well, I mean, we just keep changing the denominator. Like, I feel like we got to agree on something. We can't just keep
No, but that's
changing
very
the
critical.
denominator.
No, it's not the denominator. It's the critical point, which is the Fed balance sheet growing creates, there was an optionality at some point. The Fed could have said, we're not going to grow our balance sheet, full stop, and we're going to see rates rise. And we will deal with that. We will let rates rise wherever they go. But the other option is we are going to grow our balance sheet and we are going to let dollar liquidity into the system. That dollar liquidity is going to find the U.S. stock market. That's what we're seeing. That's what we've seen since 2008.
And you don't think that that then disproves any risk of a major economic event because of a bubble? Because I would think, my point is that when you're describing the bond market as being in such a big bubble, I would think when that thing blows up, it's going to be a major problem for that country, right? But I'm saying, one, is that the bond market did kind of blow up in 2022, and we're in pretty good shape. And a lot of the things that you're describing have been trending since post-GFC, and gold's done well for sure, but like we could go to a lot of other assets that have done very well too. So it's the connection between the two, I guess, that I'm arguing. But
when bond market bubbles pop, there's two ways they can pop. They can pop nominally, which is the price of everything goes down, the value of everything goes down, or they can pop on a real basis because the central bank will not allow the bond market to trade where it should trade to. And if that's the case, and they do that by growing their balance sheet, and that's probably the right thing to do, but the symptoms of that are going to be gold at all-time highs despite rising real rates. It's going to be the stock market growing or hockey sticking against the long bond. It's going to be gold hockey sticking against the long bond. It's going to be the U.S. housing market doing incredibly well with prices still at all-time highs despite rates. It's what you're seeing. All of these things are simply symptoms of a bond market that is moving out of global sovereign bond markets, particularly at the long end, into harder assets like equities, like houses, like gold, like Bitcoin. And it's an ongoing and accelerating trend, and you can see it accelerating in the price action of these charts. Like, this isn't speculative. Like, call up S&P over TLT, call up gold over TLT, call up housing over TLT.
Sure.
Look at all these charts. They're all the same chart.
I don't know. It sounds like if all these different things are going up, all these different ways to make money, maybe the bond market's, it's a good thing if it comes out. It's just, like, because I could pick a lot of different things that have done so well. Over that period, that it almost kind of seems like maybe this is the way the system's supposed to work.
It's going to be the inflation and the political situation of the U.S. That's the release valve.
I guess what I argue is that maybe this is just the way the system's supposed to work. I mean, we've done huge expansions of debt to GDP in periods in the past that match what we did during COVID, World War II. We came back around. We've come around, it seems so far, pretty well here. I guess the part about kind of thinking the ramifications of bonds is where it seems like we've tried some of this and it looks like we've been all right. Like, wouldn't the thesis have caused some more major disruption in 2022? That was a big bond sell-off.
Yeah, it was a big bond sell-off. Yeah. And we did do something similar in World War II. Now, debt to GDP, when we did it in World War II, after that debt run up, from 1946 to 1951, U.S. debt to GDP went from 110% to 55% in 5 years.
Right it down.
During that time, the United States had capital controls, and the United States also had negative real interest rates that bottomed at negative 13%. In other words, inflation ran at 13 points higher than the interest rate on the bond. Contrast that with what we've done in the case of after COVID, when we did, I agree, run up debt a similar amount. However, debt to GDP in the aftermath is now rising again. It's right. We went from 130 to 118. We're now back to 124 and rising because the Fed did not follow the same thing that they did to get it down after World War II, which was let negative real interest rates rise. And what markets are telling you is, or excuse me, let negative real interest rates stay very negative for a long period of time to get debt to GDP from 130 to 120 to 100 to 70. And during that time, the Fed was buying, they were in yield curve control. They had the curve pinned. The 3-month Treasury was pinned at 0.3%. The 10-year Treasury was pinned at 2.5%. You got every dime you were promised, and the S&P outperformed the 10-year Treasury from 1946 to 51 by 5x. 5x, the exact same dynamic you're talking about. So did it mean that the U.S. was screwed or that's losing its sovereignty or blowing up? No. All it meant was that the Treasury market got crushed on a real basis. It fell sharply against stocks. It fell sharply against inflation.
Yeah. Luke, hey, 1 minute. Give me some stuff to look for here. How does it then play itself out as you see, maybe like over the next, 6 months to a year or so? Do bonds start selling off again? Do we get new highs in yield? I mean, it feels like that's the place we should start in terms of testing the thesis, right? Yield's going to have to start ripping again then?
I think yields on the 10-year probably go back over 4, but probably not much more than that. I think where we're going to continue to see it is I think S&P over TLT will keep going up. I think gold over TLT will keep going up. I think Bitcoin over TLT will keep going up. I think inflation is going to start picking back up and reaccelerating. I think U.S. nominal growth will reaccelerate and over the next 6 months. And then we'll have to kind of revisit it. We'll see, what happens post-election and some of the policies that are implemented. But to me, it's just so crystal clear what's happening, which is that ultimately, when you have a fiscal problem, you have to maintain the nominal solvency, and you do that by injecting dollar liquidity when you need to do it. And that's really good for pretty much any asset except for the long bond. That's not to say you'll necessarily lose money in long bonds, but
that's the thing though, is that like all this and it's 4% yield? We were there a week ago. All the bond bubble talk, only 4%. That seems pretty manageable. We were there a week ago.
Yeah, and if you're buying it, you're the sucker at the card table because gold has gone from, 1,800 an ounce to 2,600 an ounce over the last year and a half.
So it's gold over long bonds. That's the trade, basically everything over long bonds. But it's not that like bonds really have to sell off a ton, I guess.
No, it's ultimately, again, the U.S. government isn't going to default. And if that's the case, they have to repeatedly inject dollar liquidity regardless of what inflation is doing, regardless of what growth is doing, regardless of what is happening. They just have to do it. And they've been doing it for 5 years now.
The view is basically buy everything but bonds, basically, right?
In essence, long bonds, yeah.
All right, Luke, thanks for the time. Fun chat. Appreciate it.
All right, thanks, Oliver.
Yeah. Luke Gromen, founder of FFT, Forest for the Trees. That's it for this edition of Market Overtime. I'm Oliver Renick. Thank you for tuning in.